welcome to all those who are watching us on Moneycontrol. I'm Ridhima Bhatnagar. In Ideas for Profit, we want to talk about Coforge strong today. The tailwind in technology, current consolidation, that does present a good opportunity is the question we're asking. If you look at the stock, formerly NIIT Technologies, had a decent Q3 with revenue at $160.8 million, showing a sequential growth of 3.8% in reported and 3.3% in constant currency. Now, the IT software and services company was one of the worst impacted IT service companies at the start of the pandemic due to the substantial revenue which came from the troubled vertical of travel and transportation. Now, the company rebounded strongly in Q2, but its order value that plunged in Q3 both on a year-on-year basis as well as a quarter-on-quarter basis. But since the stock has underperformed in the past few months, it's up 13% against 37% rally in Nifty and 31% in the IT index, and the company is looking at a strong FY22. The current phase of consolidation may just be the right opportunity to go long. If you talk about the economic fundamentals, now the revenue growth on a year-to-date basis has been 5.7% in constant currency, and the management is confident of reporting at least 6%. If you look at the constant currency growth for FY21, that's the prediction that's coming in from the management. But the strong support to growth came from two leading markets of America and EMEA, which is Europe and the Middle East and Africa. That together contributed to close to 85% of the revenue. If you look at in terms of the industries, banking, financial services, which is a share of 18%, and others, which is healthcare, high-tech, etc., with a share of 30%, that showed good sequential growth. Even the troubled travel vertical, whose share has now come down to 20% from an earlier of 28% at the end of FY20, exhibited solid sequential improvement. If you talk about the digital services comprising of product engineering and intelligent automation, they form 51% of their revenues, while cloud and infra contribute about 21%. 75% of large deals revolve around cloud. Now, of all the fundamentals, the order backlog at $501 million, which is up 18% from the year-ago period, is one of the most important reasons to dip into the stock. Besides adding 11 new clients during the quarter, the company signed two large deals. The company saw a net addition of 262 employees, and accelerated hiring is also expected in Q4. But attrition continues to be one of the lowest at 10.4% versus 10.5% in Q2, which is helped by selective wage hikes for niche skills. In Q4 as well, Coforge will play a one-time performance-based bonus to select talent to drive retention, and they will roll out broad-based salary hike effective April 2021. If you talk about the EBITDA margin, that declined by about 80 basis points quarter-on-quarter to 18% in Q3. Decline was due to selective wage hike given for niche skills, on-site bench costs, and low growth from most profitable travel accounts. Utilization, that dropped to 78.9% from high levels of last quarter, which was about 81% in Q2 of 21. In terms of geographies, rest of the world was weak, dragged down by India, and insurance, one of its key verticals, with a share of 32%. That declined due to seasonal factors, but the outlook currently is promising. Now, thanks to the strong tailwind for technology in the new normal, globally, technology stocks might continue to trade at elevated multiples as long as visibility of growth remains strong. Coforge stands out in terms of its superior execution in the last few years and is staring at a strong FY 2022. The new promoters of the company, which is Hulse BV Funds affiliated with Baring Private Equity Asia, has a significant stake of 63.9% in the company. Going by, can move to delist another peer IT service company, Hexaware, wherein Baring also had a majority stake. This remains a high profitability event that could protect the stock's downside.